Hi there, David. Thanks for joining me. Look, I thought it'd be worthwhile to have a quick chat with you. You know, you're obviously head of investment strategy for Wilson's across the Tasman in Sydney, and with the election just behind us, really opportune time to just talk about the Australian market and economy, and maybe what you're seeing over there on the back of the election and more broadly. So, thanks very much for your time. Look, just to begin with, you know, the election out of the way, I think it sort of played out the way most of the polls were pointing and the way people expected, maybe a bit bigger tilt to the independents doing a little bit better. But what's your take on that in terms of whether it affects the economic outlook for Australia and the market?
Yeah, well, thanks, Mark, and pleased to be here. You know, I think the good news is we have a clear majority for the Labor government, so it's looking like we have a clear path to a sort of a 76, 77 seat majority in a 150 seat parliament. So we've avoided perhaps the risk case of a hung parliament or a minority government. So I think that's good news from a market perspective. I don't think the market's going to be overly unnerved by a change of government. We've had 9 years of the Liberal Conservative coalition, but I don't think the market is going to be over worried here about the prospect of a Labor government. So that's, you know, relatively good news for the market. Market's been relatively calm today. So I think the market's going to give the government the benefit of the doubt for now.
And when you sort of think about, you know, the market and potential policy changes, I suppose, you know, with the outcome being largely what people expected, I guess investors have had a chance to kind of position accordingly. But are there any sectors of the Australian equity market that maybe stand out as either beneficiaries or, you know, those who might be disadvantaged by any policy changes that might be, you know, looming over the next couple of years?
Well, not really, Mark. I think it's been quite a deliberate strategy from the Labor and the government now to make themselves a relatively small target in terms of being pretty cautious in terms of any big picture policy shifts. So they've sort of campaigned on a fairly centrist approach, probably more interested in pointing out the failures of the previous government than what they're going to do, really. So I think the main changes will be more action on climate change over the next really 10 to 20 years, but nothing really dramatic from a share market implication there. More spending on childcare, and that sector's fairly small, but it's having a good day today. But broadly speaking, there weren't a lot of nasties in their policy platform. So the market is probably taking things pretty calmly today, as I think it should.
Yeah, which is good to see, isn't it? You don't want to see anything sort of too dramatic that catches people off guard. I just want to talk a little bit more broadly about the market on the whole. I mean, 2022, it's been a pretty volatile year for many parts of the world share markets. You know, the US and in particular the NASDAQ and the tech stocks have been hit pretty hard this year. Emerging markets have been pretty ugly. Here in New Zealand, our market has continued to decline, but Australia really has been a very strong market, proved very resilient compared to others around the world. The UK is really the only one, I guess, that stands out as being strong to a similar degree. But, you know, what is it about Australia that you think has made it so resilient in the face of this sell-off?
Yeah, Michael, I think it does principally come down to sector mix. So in short, a large resource sector and a relatively small tech sector. I think that's the primary driver. I think also related to that sector mix, a large banking sector, which has done not quite as well as the resource sector this year, but relatively well. The Aussie bank sector is up this year. So I think that sector composition is the primary driver. I think linked to that to some extent is the underlying health of the Australian economy. You know, the market is pretty relaxed about the outlook for the Australian economy, even now with rates starting to rise. And I think you're seeing that in certainly the performance of the banking sector so far this year. So mostly I think about sector mix. and also probably the resilience of the Australian economy and I guess the relaxed outlook for the Australian economy, at least for now, over the next year or so.
You touched on interest rates, which, I'll quiz you about that in a minute in terms of your thoughts, but China always been a big influence on the Australian economy, and I think, like New Zealand, China's your biggest export market, but for yourselves, an even greater proportion of your exports go to China, and obviously with the shutdowns that we're seeing over there, the economy's a bit of it's kind of half switched off, isn't it? So how are you feeling about that and the sort of flow through to your economy, your market? Are you seeing any real impacts, or is it just sort of being viewed as a short-term issue that'll resolve itself? Are you optimistic of China opening up again?
Well, yeah, you're right. It has been an interesting one in respect of commodity prices showing, you'd say, a remarkable degree of resilience given the extent of the slowdown in China. Possibly that's partly a function that's been more a consumption-driven slowdown than a production-driven slowdown, at least so far. So I think that has helped the commodity side, and also I think supply side constraints, particularly in key commodities like iron ore, are keeping the iron ore price hanging in there. But it is quite remarkable we can see such a dramatic slowdown in Chinese GDP, yet commodity prices are still performing relatively well. So that's been interesting. I've seen a little bit of weakness creep into the commodity complex over the past few weeks on the notion that China is underperforming. Am I an optimist or a pessimist? I think it's hard to really have a clear read on China at the moment, isn't it? Because normally you expect, well, when China starts to weaken, you get a whole lot of policy stimulus. So you sort of always tend to take that bad news as good news sort of tack, particularly in relation to commodities. But at the moment, it's a little unclear to what extent the stimulus can really generate growth, at least in the near term with this zero COVID policy. So I've got to say the Chinese outlook's probably the most uncertain it's been for a very long time. That could pose risk to Australia down the track, but at the moment, commodity prices are still pretty buoyant. So I guess the market's taking the glass half full approach. I'm a little bit cautious on how perhaps complacent the market's been around Chinese growth in the resource sector. But for now, I guess the market's seen a path through this Chinese slowdown, which I guess is far enough. But it's certainly been interesting just how resilient commodities have been in the last few months.
Yes, so far so good, but very much a watch of the space. I agree with your comments wholeheartedly. Just changing tack, talking about interest rates, and you touched on that earlier. So here in New Zealand, our Reserve Bank was one of the first to start cranking up the OCR, the policy rate last year, and since then we've seen the Fed doing the same, and the Bank of England, and the RBA is. You could say they've been a little late to the party, but they're not now. They're on that same path, aren't they, with raising interest rates? And I think that's expected to generally continue. So, how do you see corporate Australia, in terms of how is it positioned to deal with it? Company balance sheets, are they in good shape? Can they weather an interest rate sort of storm? And homeowners, the banking sector, what's your outlook against that backdrop of a normalisation of monetary policy?
Yeah, once again, it's an interesting debate. You're right in the RBA's been late. It's been probably the most, well, certainly very close to one of the most dovish central banks in the world. So we only kicked off our rate rise cycle in early May. So we've got an official cash rate now of 35 basis points. So just coming off the bottom with a 25 basis point rise a few weeks ago. The RBA has turned more hawkish relative to where it was, but it was coming from an incredibly dovish position. It wasn't too long ago the RBA was saying no rate rises till 2024. So the RBA sort of had to eat humble pie in terms of turning things around so quickly. And now, the RBA is talking, a line of argument probably more in sync with what you're seeing out of other central banks, including the Fed. But still, I think I put the RBA at the dovish end of the spectrum. So while we're looking at rate rises over the next 12 to 18 months, I think the RBA is still going to be a bit slower. We're probably talking about, I think, maybe 200 basis points of rate hikes over the next 12 months or maybe a little bit longer. So I think less than what we're likely to see in many other economies. Can the economy cope with that? I think it can. I think, as I say, corporate balance sheets, particularly listed corporate balance sheets, are in good shape. The household sector is probably a little bit more arguable, and that's partly why I think the RBA won't do that much. The pricing in the futures market is much more aggressive, and I think the futures market's got more like 300 or a bit more than that over the next 12 to 18 months. I think that's too aggressive. I think the neutral rate for Australia, where the economy might start to feel the pinch, is probably only around about 200 on the cash rate, maybe 250 is where the RBA puts it. So I don't think the RBA can or will do that much, but there's certainly more to come, given we're coming off essentially zero. I think the economy can cope. I think certainly the corporate sector can cope. Household sector a little bit more worried about, but if it's gradual and if it does only amount to, let's call it 200 basis points, I think we can have a soft landing. And certainly right now the economy is very strong, low unemployment, but I think the Achilles heel for the Australian economy is that housing sector in terms of the valuation of housing and the amount of gearing in the system. So there's a bit of risk there over the medium term, but I think the RBA knows that, and that's why I think the RBA will proceed at a pretty measured pace. We haven't got quite as much inflation in the system as other parts of the world, particularly the US, so I think the RBA will go slow on that basis and the basis that there is a lot of household debt in the system.
Yeah, really interesting. You touched on that concept of a soft landing, which I suppose is what we're all hoping will happen, and certainly what the central bankers will be trying to engineer. Lots of debate out there about whether that's realistic, given the high inflation rates around the world, and whether you have got those recessionary risks that are in front of us as those central banks try and knock inflation on the head, and whether they'll be able to do that without causing economic weakness or a recession. So are you sort of in one camp or the other, soft landing or something uglier, or are you kind of hedging your bets and acknowledging all of those outcomes? It feels to me like the path of inflation will ultimately define where we end up and how high central banks have to go. But what's your take on it at the moment?
Yeah, I think certainly in the case of Australia, I'm in the soft landing camp, because I don't think there's going to be that much coming at us in terms of rate rises. As we know the US is probably going to be the key. There, I'd still be in the soft landing camp, though I think there are more risks around what the Fed may do or might need to do, because there's obviously more inflation pressure in the US economy, and the Fed is, I think, several degrees more hawkish than the RBA. So a bit more nervous about the US economy, but I still think we will see some inflation relief, in my view, over the next 6 to 12 months from where we are at the moment. I think that will allow the Fed to, I guess, not have to do too much, in my view, on the rate rise front. I don't think at the moment, when you look at the US bond market, even though bond yields have backed up a long way, they look like they're peaking now. Famous large words, but they look like they're sort of backing away from 3%. So I don't think the bond rate's very important for the US economy. Probably even more so than the cash rate. I don't think a 2.8% 10-year bond really is an economy killer. I think it'll cause a slowdown, but I think if bond yields have peaked, and if the Fed doesn't cause another leg up in the bond yield in terms of more hawkish guidance, then I think the US economy can have a soft landing, and therefore I think at some point the market will find its footing and rally again, albeit the risk of a policy mistake is certainly there, and there's obviously tail risk coming from China, as we've discussed, Russia, Ukraine. So there's a lot of things that could upset that central case, but I still think the Fed, even though it doesn't have a great track record in engineering soft landings, I think they can do it this time around, because I do think inflation will come off the boil progressively over the next year. So our positioning, still probably a little bit cautious near term. The US market, to me, looks pretty skittish and could go lower near term. But on the basis of that soft landing scenario being the most likely central case on a 12-month view, we're not getting too bearish. So we're a little bit watchful, well diversified, looking to get more positive, but not wanting to be too aggressive in the near term, with the US market looking pretty skittish.
Yeah, really good comments. I think, if I'm honest, we're in a similar place. It does feel like we are at a little bit of a crossroads, but things could go either way, and there's sort of no guarantees that we do sort of fall into a major recession. So I think people have just got to keep their wits about them and be cautious, but not necessarily run for the hills. Let's just finish up with sort of one final question for you. I know you're a busy man and you've got to get on with your working day over there. If you were to sort of look at the Aussie market at the moment, and I'm not necessarily looking for individual companies, but can you name sort of 2 or 3 sectors of the market that you think are quite well positioned, for maybe investors that are trying to look through some of this volatility and think about, take more of a long-term view? Are there any areas of the market that you think are attractive, stack up well and maybe sort of a good place to be on balance?
Yeah, I think there's a number of areas in the market that look interesting in a broad sense. I think the Aussie banks look okay, on the basis that I think soft landing probabilities for Australia are pretty high. So I think on that basis, the Aussie banks will benefit from this rate rise cycle in terms of it benefits their net interest margins. And I'm not worried about bad debts because I think the economy is going to be okay. So I think the Aussie banks have been outperforming now for this year. I still see them at least a moderate outperformer over the coming year or possibly longer. So I think the Aussie banks offering good yields, and I think with the margin improvement, a better growth outlook than they've had for some time. So I think Aussie banks look fine. Resources, maybe a bit nuanced, depending on your ESG view. I think Aussie energy stocks, which are really LNG gas stocks, look pretty good as long as they fit into your sort of ESG framework. I think actually the cash flows coming out of the Aussie energy sector are going to be super strong. I think the market's fading the oil price and the gas price too quickly relative to what's actually going to happen, even though it's probably peaked. It's not going to come down in a hurry. So I think that the growth and cash flows out of Aussie energy are going to be very good. Then, without wanting to get too stock specific, you've probably got your high quality, sort of higher PE type stocks in some of the areas like some of those platform companies around, the dominant real estate, car platforms, employment platforms. Those sort of online platforms have come back a long way. We like those sorts of names without wanting to get too stock specific. Some other quality industrials have come back a long way with this sort of broad move out of growth. So we like some of those names. So I think there's plenty of interesting opportunities in Australia. Ultimately it can get quite stock specific when you get down to it, but I think there's plenty of opportunity and still plenty of good medium-term growth prospects in Australia, and valuations are more reasonable than they were 3 to 6 months ago. So we're feeling relatively comfortable with the Aussie market as long as the US market behaves itself over the next 12 months.
Always the silver lining, isn't it? You get a period like this where markets are weak, and as disconcerting as that is for newer investors or for younger investors, people with a long-term outlook, periods like this are great actually, because you get to do some buying, and it does always throw up opportunities. So great to hear that you're still seeing those areas of the market where you're seeing value and looking to put capital to work. Look, we might leave it there. I've taken up enough of your time, David, but your comments are appreciated and really interesting to hear how you're seeing it on the ground in Australia, both in terms of the election and the potential policy changes there, and as the economy sort of develops with what we're seeing in China and on the interest rate front, and in the context of a reasonably volatile global period. So much appreciated, and thanks for your time.
Yeah, thanks, Mark. Good to talk to you.